Are you an Australian NRI or an Indian origin Australian with your money sitting in superannuation growing ever so slowly? What if you could take control, compound smarter and plan flexibly for your retirement, whether you stay in Australia or return back to India? Because here's the reality, many Australians aged between 65 and 70 are still working post-retirement, not out of choice but because their super simply didn't grow fast enough. Now, in this video, let's look a lot more on this in a detailed manner. Let's start with what is superannuation. In Australia, superannuation or super is your mandatory retirement savings. Your employer contributes a part of your income to it and it's invested on your behalf. It's regulated, structured and tax efficient. But here's the issue. You have very limited control over where your money is actually being invested. Whether you know it or not, most super funds are already invested in equities, but often through complex layers of funds that make it hard to see where your money truly grows. Haven't you ever wondered why your superannuation returns aren't higher and why there's so little transparency? The returns, while being modest and often lacking transparency, make it difficult to understand what's really driving your portfolio, whether it's actually growing or just treading water. Why not just take and look at your super statement to know more about this? Now, some super funds allocate to property or low yielding assets, while even those invested in equities often don't give you full visibility of your entire performance. High fees, limited diversification and muted returns can slow down real wealth creation, leaving your retirement corpus smaller than it could actually be. That's why many investors are now exploring self-managed super funds or the SMSF route to take control, invest more strategically and access high growth global opportunities like Indian equities, which have consistently delivered stronger long-term returns. Understanding where your super goes is the first step. The real goal is knowing how to make it grow. Now, coming to what is a self-managed super fund or an SMSF. A self-managed super fund or SMSF is your gateway to control of your super. Instead of letting your money sit in default super funds, you became the trustee. You make the calls, you choose where your money is going to be actually invested. It gives you the flexibility to align your investments with your goals, your risk appetite and your vision for the future. You can merge your spouse's super into a single SMSF, contribute monthly or quarterly, create a portfolio that truly represents your actual financial journey. After all, your super balance is the result of your years of career success. So why shouldn't that success also reflect in your own financial growth? By exploring opportunities in high growth markets like India, your super can work harder, grow faster and help you move closer to a more confident, successful retirement. Now, let's dive a little bit deep into a brief context on the Australian market and how it has been real estate oriented since the start. Let's talk about Australia's favorite investment. You guessed it, it's right, it's property. For decades, owning a home has been seen as the ultimate financial milestone. It's part of the culture. Buy a house, hold it for life and watch it grow in value. But here's the thing. Even within the super, this mindset continues. Many SMSF investors prefer real estate thinking it's safer or more tangible. Yet real estate bought through super attracts additional mortgage interest, maintenance cost and ongoing expenses. And your subsequent contribution go towards reducing debt and not building actual wealth. That means your fresh contributions aren't working optimally for you. Indian equities, on the other hand, offer transparency, liquidity and potential for stronger compounding returns. Now, compare this to India. If someone had invested in Indian equities over the past 20 years, they would have earned around 13.7% per year, turning their corpus into nearly 13 times the original amount. While property may double every 10 to 12 years, Indian equities have shown the potential to double every 5 to 6 years. So, the real question is, do you want to reduce real estate debt or create actual wealth? Because when it comes to long-term wealth, Indian equities clearly stand out as a serious opportunity to divert your super funds towards it. Let's look at the importance of higher yielding assets and why do you actually need this. A little bit of data. As of 2025, Australian households' wealth stands at $17 trillion with over 4.1 trillion sitting in superannuation. But here's the challenge. A large portion of this is invested in slow growing or low yielding assets. Why don't we talk numbers? If your super earns around 3% annually and inflation averages, let's say 2.5%, your real return is barely 0.5%. In simple terms, your wealth is growing slower than your living costs. That's where higher yielding assets like equities make all the difference. Over the past decade, India's Nifty 50 has delivered close to 12 to 13% annualized returns, driven by strong corporate growth and a young expanding demographic economy. And professionally managed portfolios such as structured equity products that actively seek alpha over benchmark while taking care of risk have historically shown the potential to outperform even the broader index. In short, by reallocating to higher growth markets and strategies, your super can not only work harder but grow faster towards true long-term wealth creation. Why do Indian equities make sense? When we look globally, India stands out as one of the strongest long-term growth stories. In FY 24-25, India's GDP grew around 6.5%, with Q4 alone touching nearly 7.5%, making it one of the fastest growing economies. Over the past decade, the Nifty 50 has again shown close to 12 to 13% strong performance annualized, powered by strong earnings growth, innovation, and a rapidly expanding consumer base. This combination of growth demographics and enterprise has positioned India as a key destination for global capital and a market that delivering consistent compounding over a period of time. Now, take a moment to review your own super statement. Look at your total contributions over the past 5 or 10 years and compare it with your current balance. Many investors who we've partnered with who have done this exercise discovered that their super has grown far slower than what they expected, largely due to low yielding assets and lack of active management or transparency inside their own super. If your wealth isn't growing in line with your career success, perhaps it's time to rethink your super. Whether your super is working and whether it's truly positioned towards the next decade of global growth. Because you should not lose out on the power of compounding. Talking about the power of compounding, let's talk a little bit about it. Say your super balance is 200,000 Australian dollars today and you contribute $2,000 every month. If it stays in a standard plan growing at 6% a year, in 10 years you would have made around $650,000. In 15 years you would have made just over $1 million. In 20 years you would be roughly looking at $1.5 million. Now, if that same money is invested in, let's say, an actively managed equity portfolio, maybe taking an approximate rate of return of, let's say, 14 to 15%, your super balance would look like this. In 10 years, you would have reached the milestone of $1.5 million. In 15 years, you would be looking at a corpus just over $3.2 million. In 20 years' time, you're looking at a corpus that is closer to 7 million Australian dollars. The difference is huge. You're looking at an almost 5.5 million Australian dollar difference, showing the impact of investing in high growth markets over an extended period of time, like 2 decades. With an SMSF, you gain the control to direct your super towards investments that have the potential to deliver these kind of outcomes over an extended period of time. It's about making your super smarter, not just sit idle. Now let's look at one of the key questions that investors have: currency constraints between the Australian dollar and Indian rupee. Another factor smart investors consider is currency movements over the past decade. Over the past decade, that is from 2013 to 2025, the AUD has remained remarkably stable against the INR, moving just from 56.5 rupees to 55.6 per Australian dollar. This period included major events such as COVID, India's demonetization in 2016, the rollout of GST, and other global economic disruptions. Despite these, the AUD-INR exchange rate has remained largely stable, showing that currency risk over the long-term horizon has been relatively modest or not even an impact on returns. Meanwhile, your super invested in Indian equities could potentially have grown almost 5 to 10 times over the same period. Even factoring in currency fluctuations, the high growth potential of Indian equities far outweighs the risk that the currency movements might have. This is why a strategic investor focuses on long-term growth and compounding over this decadal opportunity rather than short-term currency movements. Operationally, we've kind of simplified this process for you. This is where our trusted point of contact, Mr. Prabhu, who's been ideating this product, comes into play. He has been guiding the setup of this product, assisting clients with SMSF accounts and supporting the compliance process. Here's how it actually works in process. Step 1, how do we set up your SMSF in Australia? You and your spouse can act as trustees, taking control of your super. Secondly, you will be transferring these funds to India. The SMSF funds are moved into a joint NRE account that is held in both of your trustees' name. A small note, while SMSF and bank accounts in Australia are in the fund's name, it is entirely possible in India to invest in the trustees' joint names and still comply with audits and reporting requirements. Many Australian clients investing through us have successfully completed their SMSF audits and remain compliant with the ATO or Australian Taxation Authority. So, how do you start investing in Indian equities? Using your NRE account to invest in either structured portfolio management services or through mutual fund portfolios managed by professional investment managers is entirely possible using your NRE account. Not only is this transparent and trackable, you can monitor your investments real time, ensuring your complete clarity. Compliance remains in Australia. All SMSF reporting, audits and tax obligations continue to be handled locally by your Australian tax professions in line with your ATO rules. The result: we have a compliant, legal and efficient way to invest your super in Indian growth opportunities without disrupting your existing framework. So, how does ithought as a trusted partner step in to manage your overall wealth? At ithought, we know every investor is unique. That's why we built a comprehensive ecosystem for Australian NRIs, balancing growth, safety and transparency. Here's how we approach it. Customized solution. Portfolios that are tailored to your goals, time horizon and your overall risk appetite. Efficient risk management. Diversification across asset classes, geographies reduces your concentration risk and protects your retirement savings from volatility. Transparency first. You always know exactly where your money is invested, your company, where we invest in, your percentage allocation, dividends, bonuses, splits are all completely visible to you. A focus on true compounding. Every aspect is designed to maximize the power of compounding over decades, helping your corpus grow steadily towards your retirement. Our goal and our vision is that to help you retire with confidence, knowing your super is managed smartly and just not left to any kind of chance. To help you with this, we have curated 4 unique products that cater to exactly these needs. Starting with Solitaire. Solitaire is our flagship PMS product. Solitaire was built for investors who want steady, patient wealth creation without chasing daily market noise. It's designed to protect capital during market downturns and participate in growth opportunities as well as geographic investment shocks. We follow a disciplined bottom-up multi-cap strategy, investing in businesses with strong governance, proven leadership, high growth potential and reasonable valuation. Solitaire isn't just about quick returns. It's about calm, confident compounding, low churn and strategic investing. If you value clarity, resilience and real wealth creation, Solitaire is your partner for the long term. Now, let's look at TrueBlue, our second product, the cleanest way to own India's top 50 companies. TrueBlue isn't just about market participation, it's about quality filtration. We invest only in the top best of the Nifty 50, but don't buy every single stock. We remove underperformers and focus on consistent, high quality businesses that have higher probability of compounding steadily over a period of time. It is designed as a core portfolio with a stable, clean engine built for long-term compounding. With 100% large cap exposure, low churn, strong governance and thoughtful rebalancing, TrueBlue provides clarity, conviction and control. This PMS is ideal for investors who want a predictable approach to building retirement corpus, a disciplined framework for long-term growth and peace of mind knowing that their capital is allocated thoughtfully at all points in time. Thirdly, let's look at our own multi-asset product that is curated especially for NRIs. Neo PMS invests for life and not just for market cycles. Just like life changes, market fluctuates. Your investment should be ready for both. Neo is a multi-asset product built to grow and protect your wealth over a period of time, blending various other asset classes like equities, debt, gold, commodities, global funds, ETFs, etc. We invest with foresight, tracking macro trends, identifying scalable ideas, and rebalancing actively to manage risk. Unlike mass market multi-asset funds, Neo is customized, flexible, and conviction-led, offering us true flexibility to go wherever the opportunity is. If you value structure, flexibility, and a disciplined all-weather portfolio, Neo is just the right fit for you. Now let's look at our final product, Vriddhi. Vriddhi hunts for emerging giants with a long-term focus in place. Vriddhi isn't about chasing hype, it's about discovering India's next market leaders before the crowd. We focus on mid, small and micro cap companies with real growth potential, strong governance and clean balance sheet. So what is our edge? We do private equity style research, deep dive due diligence, disciplined valuation based investing and calibrated capital deployment. If you're looking to invest a portion of your retirement corpus and aim to generate good returns over a long period of time, then Vriddhi is the right partner for you in this journey. Vriddhi offers a structured way of investing to participate in India's next wave of market leaders. Now, let's talk about one more key aspect that most investors miss out. The effect of continuous contributions on the compounding process. Every contribution to your super is an opportunity to grow your future. When structured through an SMSF and invested smartly, your corpus compounds far faster than in conventional super funds. With Indian equities, you gain full transparency, individual accounts, detailed statements, and clarity that traditional super funds often lack. Imagine this, you put in a sum of money every month towards wealth creation. Over a period of time, not only does this compound, this leads to true wealth creation. Smart, disciplined investing today can turn your regular contributions into significant wealth over a period of time. Now, so what are you waiting for? Your superannuation shouldn't just sit idle, it should work with purpose. With SMSF, you gain control, flexibility, and smarter compounding. And with the help of Indian equities, ithought can help enhance your retirement outcome. So, join our exclusive webinar and see how structured investing can transform your super. So, what are you waiting for? Go ahead and register using the link in the description.